Hello everybody. In this video, we will discuss about the different cognitive biases as part of the behavior and finance lecture series. The first bias, before discussing different types of bias, maybe I'll give you a brief on what cognitive biases are. Cognitive bias refers to any thought process that deviates from rationality. Like there's any new thought process that doesn't usually happen, or if there's some deviation from normal, then we call it cognitive bias. With respect to behavioral phenomena, there are a lot of cognitive bias. The first is overconfidence bias. Overconfidence bias occurs when investors overestimate their ability to predict market movements or recessions. When I'm overconfident about my predictive and speculative capacities, that is overconfidence bias. For example, if I believe that I have extraordinary and superior stock picking skills, or I believe that I'm very strong at predictive abilities and start doing excessive trading, I invest a lot of money than I should actually do, then that is overconfidence bias. So, overconfidence bias leads to excessive risk taking and over trading. It often results in lower returns due to transaction costs and poor decision making. This can be controlled by regularly reviewing and challenging one's assumptions and by diversifying investments to reduce the impact of individual errors. The second bias is herd behavior. Herd behavior occurs when individuals follow the actions of a larger group, often disregarding their own analysis. Like I just randomly do what everybody is doing rather than thinking whether that's right or not. For example, I buy a stock during a market rally because everybody else is buying it. Or I sell a stock off because I predict that the market will crash and everybody is selling it off. So this will definitely lead to market bubbles or crashes because there's always a collective irrationality. Everybody in the herd is irrational. So due to that collective irrationality, this may lead to market bubbles or crashes. This will also cause mispricing of assets as prices are driven by emotions rather than fundamentals. Herd behavior can be reduced by conducting independent research and analysis before making decisions. Herd behavior can also be controlled by staying disciplined and sticking to a long-term investment strategy than just following what everybody is doing. Third cognitive bias is loss aversion. Loss aversion refers to the tendency to prefer avoiding losses rather than acquiring equivalent gains. So, for example, holding on to losing investments so that I don't want to actually face a loss. Like if I sell off that investment, then I will realize that I'm losing. So I don't want to sell. I will pacify myself telling that that's not possible. This is one loss aversion example. The other being uh, selling winning investments too early so that I'll be able to give myself a boost that I've won. So in either way, that's going to be a problem. Loss aversion results in poor investment decisions, such as holding on to losing stocks for too long. This may lead to suboptimal portfolio performance by selling winners and keeping losers. Loss aversion can be mitigated by setting predefined stop loss limits and by focusing on long-term performance rather than short-term losses. The next bias is confirmation bias, where we search for the tendency or we have the tendency to seek out for information that confirms our pre-existing beliefs. Like I believe something, I assume something, and I search for information that will only support my assumption. And I ignore everything that is contradictory to my belief. So, for example, if I only read the news in the newspaper that supports the stock that I own, I only read those news that tell that my stock will win, and I will intentionally avoid the news that is going to tell that my stock is at risk. Or if somebody is openly disregardful of the negative analysis about a favored investment, this is again confirmation bias. Confirmation bias can lead to overconfidence and reinforces existing biases, leading to poor investment decisions. This results in a lack of diversification due to over reliance on favored information. This can be mitigated by actively seeking out opposing viewpoints and conducting a balanced analysis. By regularly revisiting and questioning one's investment thesis, we may also be able to reduce confirmation bias. The next set of bias is anchoring bias. Anchoring bias occurs when investors rely too heavily on the first piece of information they receive. That is the anchor. They rely on the first piece and they assume that the first piece is the permanent piece of information. For example, basing investment decisions on an initial stock price rather than its current value. Because a stock sold out or a stock was launched at a higher price, we still believe that the stock is going to be at a higher price. Overemphasizing historical prices when predicting future movements, like giving a lot of importance to historical data rather than predicting future movements. This would lead to underreacting to new information or overreacting to initial data. This may also result in missed opportunities or holding on to investments based on outdated information. Anchoring bias can be mitigated by being aware of the anchor and making adjustments based on current relevant data, by regularly updating one's investment strategy to reflect new information. The next bias is recency bias. Recency bias occurs when investors place too much emphasis on recent events, believing that they are more indicative of future outcomes than they actually are. So, assuming that a stock's recent performance will continue indefinitely or overreacting to short term market movements are good examples. This leads to overconfidence bias. This may also lead to a lack of diversification because we are over reliant on favored information. So maybe if we could effectively seek out to opposing viewpoints, this may be of help. So recency bias will lead to short-term thinking and reactive investment decisions. This may cause investors to chase trends or sell during temporary downturns. This can be maintained with a long-term perspective and focusing on overall trends rather than recent events by diversifying across different time horizons to balance the impact of recency bias. Hope this video was helpful. Thanks for watching. I'll come back with another interesting content.